it's a revelation that I used to talk about a little bit back in the day, but I think it's worth talking about again because I think we've just got different people here. I want to basically talk about why, let's say, normal trading doesn't work. If you go back, let's say 50, no, not even 50 years, probably even like 30 years, a lot of the trading education that you see that's free on Google, etc., it all came down from old school hedge fund managers. Old school hedgies. So, you know, the turtle traders, you know, all the old school heroes in, you know, the Market Wizards books and stuff like that. Nearly all of the trading type stuff that you see these days really originated from the old school hedge fund traders, so Paul Tudor Jones and etc. etc. Now, they taught a style of trading. Let's just draw it in a circle. They taught this style of trading. And that style of trading is the least risky, best way to trade that should generate anywhere between minus 7% per year to, let's say, 20% per year. Okay? And that's because they're hedge fund traders. You know, they're sat there on billions. And so their whole method is to basically not go outside of those parameters. Or even it would be minus 5% or plus 5, you know. That would literally be their bowling lanes. And because they're sat there on billions, if they may even take 10% in a year, everyone's happy. Because if they make 10% on, you know, $10 billion AUM, that means they've made $1 billion profit, which means all of a sudden they've made hundreds of millions in bonuses, etc. So what happened is that this style, let's just say the normal style, that then permeated into the internet and, you know, retail trading from, let's say, the 1990s onwards. So you have all of these methods basically constantly being propagated over and over and over, to the point where even now these days a lot of these normal trading methods are still being taught. Hell, I have taught you a lot of those normal methods, and by the way, they still work if, and the key thing here is if you want a pretty bulletproof way to trade to make anywhere from minus 5% a year to plus 20% a year. Okay, and that and if I was to really put that in a nutshell and, you know, big black tar brush, it would be like I've always said. You have big bowling lane, and so in terms of risk, let's say the big bowling lane is, you know, you'll never go more than minus 5% in a year, and the upside is, you know, let's say 20%. And it wouldn't be much more than that, because as you get to sort of 20% up, you then start aggressively profit taking and cutting down risk. And then you'd have certain strategies. So you'd have this strategy, which is a mini bowling lane, another mini bowling lane, and another mini bowling lane. And each strategy in itself will have its own little criteria, which you can't get out of in terms of risk. So whatever, you know, this risk, this one per year is not supposed to lose more than, say, 1% in a year, blah, 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 blah. So by having all of these the big bowling lanes and then the mini bowling lanes, and then each method, you know, you're literally risking like 0.05% max risk per trade, etc., etc. There is literally no way you can lose more than 5% in a year because of the amount of strict stuff. And not just that, if you were to then equivalate that into, let's say, a calendar approach, let's say, so that's beginning of the year, Q1, Q2, Q3, Q4, you then have your bowling lanes per quarter. So you're not allowed to lose more than X% of money by Q1, and if you do, you have to stop trading. So if in the first week or first month of Q1 you blow your load and you're down 2-3%, and I don't know, whatever your targets are, you're not allowed to trade until the end of Q1. And then at the beginning of Q2 you can then start trading again. So even if you are an absolute mess all year round, because of these stringent risk management procedures, and let's say you blow your load in the first week of every quarter, you still ended the year, only minus 5%, because you've been sat on the sidelines, sin-binned, from your trading rules. And also, all these hedge funds, they'd have a risk manager who is basically in charge of all of the traders on the floor. So if any trader busted through their, mini hurdles or mini risk or whatever, they would literally just delete the passwords, and you're like, you are not allowed to trade until X date. So all this is hunky-dory, isn't it? If, let's say, you have shitloads of money. Hell, even if you had, say, £50 million or £10 million in your trading account, let's say 10 million, and you're happy, making 10% per year, because 10% per year is still £1 million profit, it's actually, it's worth your time and effort. But going back to what I said over here, why normal trading doesn't work, and the key thing is here, for retail, is because what is the average account size for a normal retail trader? The normal account size for a normal retail trader is going to be anywhere between 1 to 10 grand. Or even less. So let's say from 0 to 10 grand on average. So let's take the upper limit of that, so 10k. And let's say you're very strict with yourself and you're making a consistent 10% per year. A lot of people will be happy with that. Whoop-de-doo, you've made £1,000. £1,000 probably, most likely, doesn't cover your time that you've spent with all the trading. And let's say you did that every year. It's not going to change your life if you just make £1,000 a year from trading. It's going to pay not even your groceries every year. So the normal way of trading is solid if you treat it like a solid, like I've outlined over here. If you treat it like you are a trader on the floor of a hedge fund, or more like a prop desk actually. There's only two things you can do as a retail trader. You either stick to this airtight methodology, and then you've got to focus on fundraising. Or what do? You've got to adjust methodology. Now, how are you going to adjust the methodology? So let's say you're capped at 10k and you can't get any fundraising for whatever reason. And you want more than £1,000 a month or £1,000 a year of profits. The only thing you can do is like a ship. You've got to put some holes in your ship and accept more risk. You then have to accept more risk. Now, that's a sliding scale, isn't it? Some people accept max risk and then blow up the whole ship. And some, so it's a sliding scale of you have to accept more risk. If you're stuck with the 10 grand or less, you have to, you have to adjust your methodology. Now, with crypto, this is probably give you a bit more insight to where I sit when it comes to crypto. Two things actually. Let's go back in the past. I came to this conclusion a long time ago, probably 10 years ago. So the first thing I did was okay, I'm good at trading. I just need to get more money. I just need to add zeros to my trading account. What do? So I then focus on fundraising. So I got into business. I thought, actually I could fund my trading account through business. And I did, probably put a 0 on the end of whatever I had, or a couple of zeros. But it still didn't cut the mustard. So let's say you have 100 grand in your account and you're still making your 10%. You made 10 grand in a year. It doesn't change your life. Like an extra 10 grand, what is that? An extra 800 quid a month. Doesn't change your life too much. I wanted more. So then I realised, shit, unless I get really big in my businesses, it's not going to cut the mustard. So I then really focus on this. So I went down, the borrowing money route. And that's what I've always done. I've literally gone out into the market, borrowed as much as I can, whatever. And by the way, the realistic trader, as in the company, will always borrow money at 10%. Always. So if you got, so if someone says, hey Siam, I've got 100 grand, I will always borrow 100 grand plus and pay 10% all day long. Because historically, all I've done is I've traded it, I've made more than that. And by the way, there's loads of people in RT where we've had corporate debts where we've done it for 3-4 years and paid it all back, and everything is great. I paid back 100 grand debt last month actually. I quite like paying back the debts. So because it's basically a business deal gone right, and it's not often that business deals go right. Anyway, so there's that way. Yeah, so you can go that way. That's one route, but it is a lot of hard work. The alternate way is adjust the methodology. So when it comes to crypto, oh dear, who's ringing me? Am I in trouble? No. So with crypto, we have to be. So before this, by the way, with all of this, most of the time, I've always done it with FX, right? So you don't give a shit about acquiring euros or yen or rupees or anything like that. You just don't care. You're simply trading the movement of it. So when I used to trade euro dollar, cable or whatever, I'm just trading the movement of it. I never wanted to accumulate any of it. But crypto, it changes things because when you get into the whole, you fully understand the crypto fundamentals, you actually want to stack sats. You want to accumulate your Bitcoin wealth, because Bitcoin is the only thing that's not whittling away compared to USM2. So all of a sudden now we can change our methodology and also accept a bit more risk, so that you in the long term are always stacking sats, and you're always getting more Bitcoin value in your portfolio than the year before, or the last cycle, or whatever. So what this then means is that all of a sudden, one of the things you can do are positional trades. Come on, trades. And sidestepping. So you can still do the normal trading, like you've all learned and got used to, etc. But you can add in positional trades. So very timed positional trades, which if go well, you massively increase your Bitcoin portfolio, and or sidestepping. So just like in a bear market, like I've always said, if you think there's more falling to come, you exit, you sit in cash, and then you wait for it to fall, and then you buy in. And then great if it's near the lows, but if it looks like it's about to fall again, you sell. And then even if you keep doing this, and because you can never pick the bottom, you'll be bleeding your dollar portfolio, which is technically it's just a book loss. It's not a real loss. But whilst you're sidestepping in and out, your sat wealth is going up, as in your satoshis, how much crypto you actually have. So so this way, you will accept more risk in this from a dollar perspective of your whole account, but in the long run, when the bull market returns, and it always does, then you'll be golden. And that is how you can turn a very small account into a very big account over time. Just ask any RT member that was in from the beginning of 2017 to the end of 2018. Like it was, the whole community was just awash with people going, oh yeah, I've turned my 10 grand into 200 grand and stuff like that. And then during the bear market, they go, oh shit, I've gone from 200 grand back down to 50. But what always happens is, most of the time, yes, they lost a fortune, but they still ended up with more than their original 10 grand, let's say, or whatever their number is. So, that's just my little, I think it's worth understanding why normal trading doesn't work unless you can just increase the numbers. And what happens, people do realize this, but they don't really fully understand it in this whole context. Because they go, oh, Simon's taught me, or not just me, but I've learned trading, how to trade. I've learned all this proper stuff, and it's bollocks. Doesn't work. I only make 1% a year or 10% a year, and it's peanuts because I've only got a grand account or whatever. And so they then subconsciously go, oh, this doesn't work. I'm going to throw this out with baby in the bathwater, and I'm just, instead of going at 1%, 0.25% max risk, whatever. I'm going to go in at 2% max risk. And so they're accepting more risk in their whole portfolio than they actually understand. But with none of the smart, stuff. So yeah. Anyway, just a little thought I had the other day.